All right, why don't we get going here? We'll make sure to keep this to an hour. This presentation is being recorded as well, so if you have to hop off early for any reason, or if you know of anybody who you think might benefit from it, we'll have it up on the website after we're done here. Today, we're going to be going over a mid-year investment update. I'm Tanner Wrisley. I'm the President, CEO, Chief Investment Officer at Anchor Bay Capital, and I have with me Cory, our portfolio strategist. We're going to talk about a number of things today that we think you'll find interesting. And just wanted to mention too, there is a question function. So if you have any questions as we go along, feel free to pop them into the chat, and we'll probably address them all at the end. But just so you don't forget, feel free to pop them in there, and we'll get back to them, and we'll make sure that we get them all answered up before we wrap up. So I am going to go ahead and get started here. Let's get that PowerPoint going. Sorry. All right, here we go. You see this okay? So we're going to give a market and economic update. Some of the things we'll talk about today, economic backdrop, what's going on in the economy currently, some metrics about inflation and unemployment and things going on with interest rates and the Fed, how the market has been performing so far this year and the different indices and how we measure those. And then within the market, what sectors and industries are doing well or poorly. And then we're going to review, we're going to go back to what we outlined in our first investment webinar back in February this year. We outlined some of our thematic positions, some themes that we're going to be employing in our portfolios this year. And so we're going to review those and see, how those are doing and what we're feeling is going on with each of those positions and with those themes. And then a little bonus section on SpaceX. It's been obviously in the headlines a lot in the last month since it IPO'd. So we'll talk about what we're doing with SpaceX or not doing in our portfolios, with our clients' portfolios, and just a little bit about where that company is and some more information there. So we'll jump right into economics. So this is a chart of the CPI index, which is a measure of inflation, and it goes back the last 5+ years. There's two measures here. Both are CPI. One includes all prices, and that's the solid blue line. And then the dotted blue line is with energy and food removed. They remove those from and get sort of a second reading because a lot of times the Fed feels that those prices are somewhat out of their control. For example, we see this year there's been a divergence in those two indices because of the price of oil, which increases energy costs. So as soon as we got into this conflict with Iran, you can see, and I'll pull out my laser pointer here. This basically correlates with the Iran conflict ramping up, and all of a sudden you see the total CPI index diverge from what they call the core index, which does not include energy prices. So that's where we stand right now. It has come down a little bit, but these readings are lagged. So the last reading showed a decline in prices actually month over month, but that was for the June reading. I imagine July is going to be back up once we're all said and done. The other part, so inflation and keeping prices under control is one part of the Fed's mandate. The other part is making sure that there's good employment in our economy. So this is the unemployment rate. You can see it starts out at around 5% back in 2016 and spikes during COVID, and then normalizes again and sits around. It was down into the high threes, but low fours really for the last several years. We had the government shutdown, and there was no data taken for a couple months. But we ended up at the last reading at 4.3 on the unemployment rate, which is pretty neutral. Not too high or not too low. That's not that far off of what the Fed has stated as is full employment or a normal / healthy amount of employment in the U.S. economy.
Tanner,
Yeah.
would you argue right now that the Fed is most likely more concerned with inflation and doing what it takes to tame it at this point? Obviously unemployment is the other side of it, but it does seem like there's been more of a shock, and for the most part, it's like you said, out of their control with oil. Do you think inflation is what they're looking at most at the current moment?
Yeah, that's a great question. I would say yes. And actually, this slide sort of illustrates that. So I know there's a lot of numbers on here, but just bear with me, follow my laser pointer, and we'll get through it. So the unemployment rate here is this row. 4.3 is what the Fed at the last meeting, which was in June, is what the Fed expects the unemployment rate to be at the end of the year. 4.2 is what the Fed is basically saying it's shooting for. So we're almost right in line with what the Fed expects in sort of a neutral environment or in the long run. So that would tell me they're not so concerned with or worried about unemployment at the moment. Conversely, if you look at the PCE, which is the Fed's version of CPI or the Fed's reading for inflation, that's at 3.6 versus a 2.0 target. So significantly above, almost double what the Fed is shooting for in terms of inflation, or in terms of like a long-term standing price increase. So definitely the emphasis for the Fed right now is going to be on curbing inflation. So what does that mean for us, for investors, and for all Americans living in this economy? Is they're going to be more focused on bringing interest rates up, because when inflation is the worry, um, the way that you curb inflation is by hiking rates. And so that's what we saw at this last meeting in June. The Fed had previously been projecting for one rate cut by the end of the year, and they actually flipped it to one hike by the end of the year. So, in other words, it was a whole, when we say one rate cut or one hike, we're talking about 0.25% or a quarter of a percent. So they went from a quarter of a percent cut to a quarter of a percent hike. So if you're following along, that's a 0.5% change. So that changed a little bit with what we're expecting in terms of interest rates, and it's really brought on because of this inflation piece, and because unemployment rate from the Fed's view right now is actually at a good spot. So you would cut rates if you're worried about unemployment. You would hike rates if you're worried about inflation, and if you're not worried about anything, then you don't do anything.
Mm-hmm.
But essentially, the next worry for the Fed is definitely prices.
Yeah, I think an important caveat too is that with inflation and a lot of these types of readings, you the Fed is actually wanting a healthy level of inflation. Now, nobody likes seeing price increases. In a perfect world, we all like prices to stay the same forever or even drop. But those can have more broader economic impacts. I think it's important to note that when you see a number like the PCE inflation that's on this chart at 3.6, and you see the target for the Fed in the longer run of 2, it doesn't mean they expect prices to come down within the basket of goods that they're measuring. They just want the change of pace to accelerate. And so they want a healthy amount of inflation because that means that everyone in the economy is spending a little bit of money. They're increasing their spending, and that helps companies stay afloat. That helps companies employ people. It has broader implications. So the Fed does want some level of inflation because that indicates a healthy economy. But when it is past their target of that 2%, like we have now, it is of concern because if prices increase too much to the point where consumers can't handle it, you're going to have a bigger problem in your hands on that side of things too. So I just wanted to
Yep.
point that out before we move on from here.
It's a great point. Going from 3.6 to 2 sounds like prices are decreasing, but like Corey just explained, this is a growth rate. So if if next reading was 2% inflation, prices still went up by 2%. They just weren't going up as fast as they were the month before. Um, yeah, if we see a negative number, if you see like a -1 on inflation, that's usually a bad sign. It's nice, yeah, prices went down and it's cheaper to buy milk at the grocery store, but usually that's coming with other issues like recessions. So um, the Fed is looking for what they call disinflation, and that's where inflation is still positive. Prices are still going up. They're just going up slower than they were before. So that's really the sweet spot that they're looking for. So this plays into interest rates, which we care about when we invest, and for a lot of other reasons as well. But this chart shows interest rates or what we call the yield curve. So it's showing you what are the if you buy a treasury bond, what is the interest rate or the yield that you're receiving at different lengths. And we've got two lines here. So the red line is showing you where interest rates were a year ago, and the blue line is showing you where interest rates are today. So if we just ignore the blue line for a second and go off the red line and how interest rates were a year ago, you can see um, interest rates sort of had what we call a belly in the curve, where at 2 months you were getting paid almost 4.5% yield. So you buy a bond that matures in 2 months and you get your money back in 2 months, and you're getting paid more interest than if you were holding a bond, I guess, a more interest rate or higher yield than if you were holding a bond for 2 years. So, that doesn't necessarily make sense on the surface. You should, and we've talked about this before, you want to be paid. You're locking up your money for a longer period of time. You should be compensated higher for that, not lower. But the reason that it was bellied out like this was because there was an expectation that rates were going to lower in the future. Now the curve is doing what we call normalizing, or it's up and to the right. So the longer you wait, the longer out you're buying bonds, the more yield you're receiving. And that intuitively makes sense. I'm getting paid more to buy a 10-year bond and lock up my money for a decade. I want to get compensated more than if I'm buying a bond for 3 months and I'm going to get my money back in a quarter, essentially. So when we have a normalized yield curve like this, it's essentially the market saying we expect interest rates to increase in the future. So, what are we doing with this information? We don't like to make huge bets against the market in terms of trying to guess where interest rates are going. But a lot of times, what we do like to look at is stuff like this, like where is the yield curve the steepest? Like the difference of buying a 2 year and a 3 year bond is fairly similar in terms of yield. So it doesn't feel like we would want to buy a whole lot of bonds that are maturing in, these are for treasuries specifically, bonds that are maturing in 2029, because it's, you can buy a bond that matures in 2028 and get paid the same amount. Whereas if you go from 1 year to 2 year, well, yeah, there actually is a pretty nice difference there. And so what we like to do is buy on this end of the sharp part, um, and that way, you feel like you're getting more compensation for waiting a little bit longer.
Yeah, and we buy bonds of all different maturities, regardless of what the current landscape looks like. But in terms of being an active manager, the way that we can maybe produce a little bit of outperformance or what they call alpha is we look at things like the steepening of the curve, where it is a much bigger difference from 1 year to 2 year, or if you even look much further from 10 year to 20 year. And sometimes we will maybe over allocate towards those areas. But needless to say, like Tanner was mentioning, we don't like to make big predictions against the market. So we do like to stay fully diversified across, all different maturities. We'll just shift the portfolio and the fixed income part of the portfolio based on where the yield curve is at a given moment. And for right now, like Tanner mentioned, we do have a normalized yield curve. So, the risk to reward pretty much is what you'd expect as you go out further and further with the maturities. So I'd say, the difference of what we were buying more of a year ago was on the shorter end of the yield curve, whereas today, when we're looking at the current state of fixed income, we're looking more and more towards the longer portions of the yield curve because we're being compensated more for it. So that's part of the insight of what we're doing and looking at constantly for the fixed income part of portfolios. And the yield curve is a very powerful tool to use in order to dictate, where to over allocate versus under allocate. So just thought I'd mention that.
Yep. Yeah, we diversify by maturity within treasuries, because if you're buying, treasuries are all issued by the US government. So it's not like you buy a stock in tech versus buying a stock in healthcare, and you're diversifying from different economic events. Treasuries all have the same sort of risk profile. They're just subject to different interest rates at different lengths. And so you diversify by buying at different maturities, just like Cory said. So we'll shift over to how is the market and how stocks done so far this year. Cory put together this chart that shows different stock indexes. So the one that people typically use to measure the U.S. stock market and to measure the larger companies, the S&P 500, up about 9% so far this year. The NASDAQ, which is going to have more weight towards technology, up about 16. The Russell 2000 up 19. That's smaller companies, what we call small caps, and smaller companies, little higher growth profile, but also higher risk. And then the Dow up 8%. This S&P equal weight is, I'd like to show this because it's the same 500 companies that are in the S&P, what people typically call the S&P 500, but it's a market weighted index. So it's essentially taking and giving the largest percentage weight to companies that are the largest in terms of their total market capitalization.
Mhm.
So right now, the largest company in the U.S. is NVIDIA. So NVIDIA gets the highest weighting, and then Apple is hot on their tail, and so Apple gets the second highest weighting. Um, the S&P has slowly become, in the last several years, very top weighted. If you've joined any of our webinars in the past, we've talked about this at length, and what a lot of people call the Mag 7 um, are large tech companies that are essentially making up more than a third of the entire index, where it's like 7 or 8 companies make up 35-36% of the weighting, even though the index is made up of 500 companies. Um, Whereas the equal weight S&P takes all 500 companies and gives them the same exact weight. And so the fact that the equal weight S&P is up over the S&P, the regular market weighted S&P, shows us that those Mag 7 companies have gotten off to a slow start so far this year compared to the rest of the index. You can actually see if you trace the purple line, that's the S&P. So you can see especially during the Iran conflict, there was a lot more downside compared to the equal weight S&P, which was actually going up sort of at the beginning while the market weighted was going down. Eventually, they crossed, and then the equal weight has eked out a little bit more. Um, but I think it's always interesting to note. We talked about in our February webinar, we talked about how we wanted to start trimming back some of our exposure to those the Mag 7 companies, not remove them entirely, but just give some love to what people affectionately call the other 493. And that turned out to be a good decision, especially in the beginning part of the year when there's a lot of volatility uh, from especially from the Mag 7, but from the Iran conflict.
It's and going back to the last slide, and when you look at this kind of return profile for each of the indices, the way I see this is there's a lot of risk being taken from investors because the Russell 2000, that's your basket of companies which are on the smaller side. That's what they call the small cap index, and so it does seem like the market is still rewarding, higher volatility type names with, with smaller companies. It does typically come with higher volatility because there's a greater chance for smaller companies to either grow very quickly or fall very quickly, just given the nature of their size and scale and ability to do things as companies. And then you see that the Nasdaq, also outperforming the S&P, and there's a lot of tech in NASDAQ, and believe it or not, technology as a whole is actually very diversified too. So you've got things like semiconductors, chips, which have seen a lot of love this year in the last 2 years because they are essential to the build out of things like data centers and enabling AI. So there's still a lot of love and a lot of return given for those types of companies. And so, what's really hampering the index, the S&P is the fact that those really large tech companies, the Microsofts, the Apples, the Amazons, the Googles, they've had a bit of a slower start because what we'll get into a little bit later is that they're fronting a lot of the spend that's going on, and investors go back and forth about whether there's a healthy amount of spend from these companies, and whether it's going to pay off in the future. And then the other side of the camp is, hey, you're taking a lot of your earnings and profitability and spending it almost entirely on this brand new shiny object. Do we know it's going to pay off? We don't know for certain. We know the technology is real, but will it have the same kind of payoff as investors expect, or as the companies expect. So that's kind of the landscape of the different indices. And if we kind of dive in a little bit more into sectors, we wanted to showcase the top performing sectors so far this year, as well as the bottom performing sectors, and then a few of the areas in between that we see a lot of value and a lot of room for excess return, for a couple of different factors. But to start things off the top, we've got energy as the highest performing sector. So these are all your big oil names, whether they're your big integrated oil names like ExxonMobil and Chevron, or it's like your oil exploration names, natural gas names. I mean, there's a lot of benefit of being an energy company in a kind of landscape that we're in today, because if you think about it, with the geopolitical stuff, the Iran war going on, it really hampers supply by a significant amount because there isn't enough oil coming through the Strait of Hormuz, which in total is about 20% of the world's oil capacity. And so a lot of the companies that can still meet the same demand that we had before the conflict are able to charge a higher price because there's less supply out there, but the same amount of demand. And so a lot of the companies like the Chevrons, the Exxons, the natural gas names, they're seeing a huge tailwind because of the conflict. And you can see, this chart starts in, beginning of this year. The conflict really ramped up in January and February, and you can see energy had a big benefit to that. Now, will this continue? It really depends on whether the geopolitical issues can be solved or not. And as many of you know, that can really change on a dime. I mean, it's extremely hard to predict when this conflict will totally end or if it'll slowly subside. But that's a riskier part of the market right now in terms of those energy companies, because it's really dependent on one side, the supply of oil, and whether that gets resolved, and two, if demand sticks, and that depends on a healthy consumer. So those two things are very uncertain. And so yes, they've had a great year so far this year, but it does not mean that it'll continue going on to the next year, especially if the conflict is resolved in the Middle East. And then the second pretty obvious place that is seeing a big boom return is tech. And I would say a majority of that return comes from your semiconductor companies and companies that are essential to building out these data centers. So you have, your electronic switches companies, your, like I said, semiconductors, and that's a full stack of tech, whether it's your normal GPUs, your CPUs, your memory chips. So there's a big ecosystem going on with the build out of data centers, and it's like we've mentioned, it's a lot of money being spent from those Mag 7 names, and a good majority of it is going towards other tech related names, but just outside of those 7 names. And so they've seen a large return this year so far. And again, that can also change on a dime if these Mag 7 companies come out and say, hey, we're not seeing as much of a return as we expected before we started spending these hundreds of billions of dollars, and that could easily bring back these return profiles for a lot of the companies within tech. And so obviously keep a close eye on that. But those are the two top performing sectors so far this year. And then on the bottom portion of performance for sectors, and we look at all 11 sectors when we go to invest. But two of the underperforming sectors so far this year are consumer discretionary and the communication sector. And I would say with discretionary, the biggest hamper on a lot of these companies, you think about companies like Lululemon, you think about Nike, you think about Under Armour. I mean, a lot of these clothing and apparel companies in particular are being hit hard from the effects of the tariffs that were introduced last year. Because when your manufacturing cost or your sourcing of raw materials goes way up, you kind of have to scramble and find a different way to produce that item at a similar cost in a different place. And so that's not an easy process for these companies to navigate. And it's also on the backs of higher inflation stemming from all the way back from 2021 to 2022. And so discretionary has had kind of a tough time throughout the last few years just because these, single one-off events, keep hampering these companies from, meeting demand in a way that doesn't hurt their margins or profitability. So there's a lot of navigating for companies in discretionary. And that's one of the places that we're more of a see and watch, before we take a lot of action in the portfolios, just because there are a lot of headwinds going against them at the moment. So, you know, if the tariff situation gets resolved, if demand either stays where it is, which has been really healthy in terms of spending from consumers, or if it even accelerates, they could see a boom again. It's just kind of a wait and see type moment for the sector at the moment. And then last but not least, we've got communications at -5% for the year so far. And I would say within that sector, it's more company specific problems, because you have such a high weighting in that sector to companies like Netflix and Meta. Those are your two biggest communications companies. And with Netflix, they've had a kind of a bit of a slow start this year because they tried to bid for Warner Bros. Discovery, when they were going up for sale, and it was a very large number. Investors were very scared of that number, of how much they're willing to pay for a catalog of different movies and shows and whatnot. They're wondering if that would be worth the spend, and so the stock saw a big pullback. It has yet to recover that, even though Netflix pulled back from that bid. And so you have a lot of one-off items like that affecting companies within the communications sector. So it's not really a broad-based underperformance as it is your specific companies that make up a big share of that sector, which are struggling so far. I'm not sure if you had anything else to add to that, Tanner, but
Yeah,
um,
I just to talk a little bit about staples too. So staples is like staples and healthcare really are supposed to be sectors that hold value sort of regardless of what the economy is doing. They're selling products. Like an example of a consumer staple is like Procter and Gamble, who owns like what's it, Crest toothpaste and things like that. That you are not spending a whole lot more on when the economy is doing well, but you're also not spending less on it when the economy is doing poorly. Same thing with healthcare. You can't really cut spending on medications that you need. And so just it was interesting to see healthcare actually traded similar to some of the lower performing sectors to start the year, whereas staples did pretty well. It's held value and actually stayed true to its characteristics here throughout the Iran conflict. And when tech was going crazy, staples was very neutral. Um, Healthcare down to start the year, and then has come back recently. Um, where does this leave us? Like, what are we doing from this point going forward, and how are we positioning things? To hit on each of these quickly, energy, I think we're going to stay neutral. It's possible that energy could go higher from here, depending on the Iran conflict. If things subside, I bet energy goes down a little bit from here. I don't think we feel comfortable making a huge bet either way. And so that is going to be one that we want to keep the exposure to, but not dramatically increase or decrease. For tech, we definitely want to take some profits here. And it's not going to be across the board because there are some areas of tech that have done poorly to start this year, despite the whole sector being up 26%. Software companies have done terribly to begin the year. Um, but then you've got companies like Cory was talking about that have done extremely well. For those companies, we feel like this is a good time to take some profits. We're not going to wholesale out of things. There might be some companies that we feel like have sort of achieved their growth goals, and maybe they do get removed from portfolios. But for the most part, it's going to be trimming here. Still feel good about staples. Depending on where we go, I feel like staples should continue to ride. Healthcare feels like there may be an opportunity here, and maybe we take some of the proceeds from tech and funnel them into healthcare. Cory and I both believe this is one area that AI has not hit yet in terms of seeing a boom. Most of the AI trades have gone into tech, but there could be real tailwinds for healthcare once AI is applied correctly, and we haven't really seen that materialize yet, nor have we seen a whole lot of talk about that. So with healthcare kind of starting slow this year, we feel like that could be a place to go with maybe some of the trimmings from our tech positions that have done really well. Okay, so we're gonna now pivot to the four. We have four thematic positions that we outlined in our February webinar. These were areas of the economy or industries that we felt strongly about overweighting or having a healthy exposure to because we felt there were some uh, long term implications that would be beneficial for having investments in these different industries. So we're going to review these are the same four that we outlined earlier this year, and we're going to sort of revisit them and talk about how they've done and where we see things going from here. Water infrastructure. This is probably the longest term play that we have. I don't feel like this is being talked about enough as an area of um, as almost like an AI play. Water's essential to the power generation that is needed for data centers and for AI. You need cooling for these generators, and water is how you cool. Uh, not you don't, and it's not just any kind of water. You need clean, filtrated water, which means you need to find that water. You need to source it. You need to bring it to the generators. You need to filter it, keep it clean, transport it, and then use it for cooling. And the companies along that process have not seen anywhere near the run up that the semiconductor and the chip companies that Cory was talking about have seen. So we feel like this has been a neglected part of the AI play that we feel like is going to hit at some time or at some point in the future, but just don't know exactly when. So we want to have that exposure and think of these companies we've listed at the bottom as long-term plays that should see some really nice returns once people realize what we think is essential to essentially the AI growth and energy generation process.
Yeah, and you'll see on this next slide, you know, even before AI became, a large process and a technology that's been, developed, scaled, all these types of things, we've had some real need for upgrading our infrastructure, and that's across the board. So, we've got this chart here, which, this is funding that's already been fronted or that's been planned for these different types of categories. It's in the dark blue. And then you've got what is estimated to be the additional funds that are needed for each category. And when we first came across this research, we were trying to decide what would be an important theme going forward. I mean, this is something we came across back in 2024, and even prior in 2023 when the infrastructure bill was passed. During the Biden administration, a bipartisan act that was passed. It was it was definitely defined that our infrastructure as a whole, in the U.S. is fairly poor. I mean, You go across the board from roads with lots of potholes and needing massive repair. You've got an electric grid that's very outdated. It was built decades ago. It can't really handle the same capacity that we need today and going forward. Um, you know, what we talked about in the slide before and what we want to emphasize is that water also has a very big need to be upgraded in terms of infrastructure. That's wastewater, that's filtering for clean water, that's transporting water to places that don't have easy access to clean water. There's just lots of investment that's needed in order to make sure that our grade as a whole, as a nation, is much higher and much more modern and updated. And so that's where we see the biggest discrepancy, as you can see here. I mean, $700 billion planned for water just from the infrastructure bill and from private investment. That's not even close to what we need. We need $2 trillion. I mean, that's a large gap that we need to be able to fill, to fund, to make sure that everyone has access, and make sure that both consumers and private companies, governments, all types of things have access to water. And so that's an area that we're trying to find opportunities for the portfolios and for our clients, in terms of broader infrastructure. Not to mention that we are also looking in different categories too. But if you were to look up, what's the civil engineer, consensus for our infrastructure grade for the U.S. If you were to go to research that, not too long ago, it was a D plus. That's not even proficient. I mean, I think we just recently got upgraded to a C minus from that think tank from those civil engineers. So we're not close to being where we could be, as a nation, and that's a bipartisan issue that we're going to need a ton of this infrastructure updated if we want to make sure that things don't fall apart, so on and so forth. So that's a big area that they've outlined, but infrastructure as a whole is a huge undertaking. And with problems that we have, there's also opportunities for companies to take proceeds from that upgrade.
Yeah, so continuing on, and this continues with the infrastructure update, and like Cory was talking about a little bit here, is just our grid needs an overhaul as well. So we're going to need all this new energy, and maybe we would need this regardless of putting in a bunch of data centers. But now that you're going to do that and run and power AI on top of all the things that take electricity that we now use on a daily basis that maybe in the past weren't taking electricity, um, there's just a massive need for all that energy. And then how do you get it around the country to the places it needs to go? Generating it is one thing, and the market has priced in a whole lot of gains for those companies that generate power. Where we feel like the market is a little bit behind is how do you get it around? And I think there will be a point in the future where we, as a country, realize we need to update our electrical grid, and that funding can come from maybe a private company, or like a company like Google is putting in a data center, so they pay for the electrical grid upgrade in that section of the country, or in that county or in that town that they're putting the data center in. Or maybe it comes from municipalities, or the federal government or states. There's a lot of different ways this revenue could come in, and we feel like this, just like the water issue, is a bipartisan um, issue where both sides should be in favor of doing something like this, a grid overhaul, putting together a legislation that pays for it. So this was our second theme, and the companies we touched on are that give us this exposure are down in the bottom of the slide here: Quanta Services, Sterling Infrastructure, etc. They're the ones that stand to benefit, should our thoughts sort of come to fruition.
Mm-hmm. Yeah, I think one factor that a lot of people don't think about when we're trying to build out a lot of these either data centers or updated infrastructure, is that we need access to a lot of skilled labor and a lot of skilled blue collar labor. And that's just something that's not talked about enough. So it's clearly outlined that if we keep going at the pace that we're wanting to go, there will be a shortage of skilled labor. And so companies that, either recruit or supply a lot of that skilled labor will definitely reap the benefits of being able to, match make projects with people that are in the industry. So a company like that is Quanta Services, which is down at the bottom there as one of the companies part of this theme. That's another big portion that we think is that's not talked about enough, and they're the front runner of supplying that skilled labor. So I think to meet this demand, there is going to have to be a shift of you know teaching younger people that you can have the option to either go the traditional route, the traditional school route, and figure out something you like on that path. But there's also this other path too, in terms of blue collar jobs that are going to pay very well. Because if we're going to update our grid, we're going to need a lot of skilled labor when it comes to building the power lines or burying the power lines or being able to build out HVAC systems for data centers, or there's the list goes on, and safe to say that we don't have that kind of I guess supply of those skilled labor. So it's going to take some effort on both ends, and we think that there are some companies that are well positioned for that for the time being.
We've got about 13 minutes here, so we'll finish up with these last two themes, and then get on to SpaceX and take any questions. So, deglobalization impacts. We noticed the current administration has taken a stance to sort of go deglobalization, bring things as part of an initiative to bring manufacturing and things back to the U.S. Um, there's implications to everything, and so once you become more insular as a country, you also force the other countries that to become more insular themselves. If they were relying on the U.S. for buying their products and relying on the U.S. economically, and then the U.S. decides to stop buying their products and only buy from within the country, um, it creates less dependence on the U.S. And in the past, the U.S. has always had that economic edge, where if you were a foreign country and you wanted to go to war or do something geopolitically against the U.S., there'd be serious economic implications, and there still would be. But one of the consequences of deglobalization will be that foreign countries become less dependent on the US economically, which might in turn allow them to maybe do some things geopolitically that they wouldn't have done before. So, and that in combination with, you know, President Trump in his first term created Space Force, and so the combination of those things, and us thinking he's going to want to see that branch that he first established, or feels that he first established, succeed. And so, might he funnel some government funds towards that branch of the military? We felt like that was a safe bet. And so the combination of those things led us to allocate towards defense companies, aerospace specifically, but also defense companies. Like I'll highlight L3 Harris as an example. They make satellites, and as part of, they've seen a lot of run up with all the hype around SpaceX, and with government winning government contracts and things of that nature. So, and even with the Iran conflict. So, this has been a very successful venture for us in terms of allocating funds, and we still feel pretty good about it for the short term future. There will be a point, maybe towards the end of the current administration's term, where we have to, decide: do we think this is going to continue across into a new administration? For the time being, though, we feel pretty good about these companies. And last theme here before we get on to SpaceX, aging demographics. So we highlight a number of companies below. Some of them I think would be pretty obvious, as people are living longer. They're spending more on healthcare, and so a company like HCA Healthcare, which does hospitals, is going to see more customers, and they're going to be able to expand and have a good growth trajectory. But some other companies, you might think, well, BlackRock or Charles Schwab, how do they fit into aging demographics? This has to do with where wealth is parked. For older generations, a lot of wealth is in real estate or in traditional banks, and a lot of younger generations are parking wealth with capital markets providers like Charles Schwab, or like in cryptos with Coinbase, or investing in options or in stocks, as opposed to investing in real estate. And so as wealth transitions from older generations to younger generations, where that wealth is parked, we see it shifting towards products or investments that have to go through these institutions, or like CBOE is an exchange, and that's an interesting investment because um, a stock exchange is sort of it's based on volume. So stock exchanges can actually be quite profitable, even though this seems counterintuitive, when the market's going down, because people are trading a lot. So it's just an interesting, we feel like it's an interesting exposure within financials that plays on aging demographics. Then you also have companies like Welltower, which is a skilled nursing facility REIT. So aging demographics, investing in doesn't just mean investing in healthcare. It can mean a whole lot of different things when you really drill down into it. All right, so let's move on to SpaceX, and we've got 5 minutes here, and then we can take some questions. Cory, I don't know if you want to run through this chart real quick, and then we can talk about the mechanics of the IPO and the lockup periods and things of that nature.
So this has by far been the hottest topic of conversation in the last few weeks, since there was some hype built up into the IPO day for SpaceX. Where would it go? Would it go straight up and all the way to the top of the most valuable companies in the world? Or is it already priced for perfection? Was there going to be a period of time where there's going to be a lot of volatility before things kind of settle down? And the answer is it's been a little bit of everything. And so when SpaceX announced that they were going to IPO, there was a lot of hype built into this in anticipation for this day they go public, because that means the general public can finally get a piece of a company which is at the forefront of their industry. When you think about companies that are not even publicly traded, but also privately traded or privately owned, there aren't many that are doing launches as much as SpaceX is. In reality, the next competitor doesn't even come close. And so there's good reason as to why there was a lot of hype going into this IPO, and it's because it's a one-of-a-kind company. They've got a variety of different segments within their business. They've got a segment called connectivity, which is their Starlink and satellite business, where they're granting access, to internet to a lot of places that don't typically have that access, as well as in just more remote areas and places like the U.S. and throughout the world. And then they've got, their space segment, which is their actual launching part of their business. So they'll partner with companies that maybe build their own satellites or build things that'll go to the International Space Station, and they'll sign a contract with SpaceX to actually launch that. And SpaceX has pretty much perfected the way of reusing rockets, and so they're able to bring things up to space, come back down, and use that same vessel to keep doing that over and over again. And that has really brought down the cost of bringing things to space. And so they do have a lot of these segments that are on the forefront of this industry. But the other side of the coin is that they've also got a very speculative side to their business, as well as, when you look at the valuation going into this IPO, investors look like they're willing to pay for earnings or profitability 10, 15 years out into the future, because SpaceX just isn't earning that amount of money, either on the top line revenue basis, but also especially on the profitability basis. And you can see here that those three segments are split up in terms of total revenue, profitability with operating income, and then capital expenditures, which is how much like cash flow they're actually throwing into these different segments. And so, as you can see, as a whole, they're not quite profitable yet. And when you're going into a valuation of $1 to $2 trillion, which is within the top 10 companies of the entire world, you better have some profits or some kind of promised demand going forward that you'll be able to reach that kind of valuation. And so there's a couple of things going against the actual stock itself that Tanner will get into, but in terms of the company actually being profitable, they aren't quite yet. The reason why they're valued so much is because they're a one-of-a-kind company. They pretty much are a monopoly in their industry. And it's seen that if they hit everything that Musk sets out to do, it is possible they could reach that kind of valuation. But for the time being, and what Tanner will explain, it seems very expensive and very volatile at the moment.
Yeah, and a point of clarification, because I'm not sure that everybody understands the mechanics of IPOs and how they work. So SpaceX IPO'd in June, and right now the value of the shares that are currently circulating through exchanges and available for you, me, Cory, or anybody to buy on a daily basis is worth 86 billion, all of those shares. However, there's 123 billion, so more than is currently circulating. 123 billion on the sidelines that's locked up with Elon Musk, private equity firms, other high-level executives at SpaceX, low-level employees at SpaceX even have shares from before the IPO. Those all add up to 123 billion that have yet to hit the market. It's all a bunch of future millionaires and some future billionaires that are just waiting to essentially sell and lock in, their new status, their new wealth status. So if all of those shares, all of those people were to say, I want to sell and buy my first yacht and do all of that, it would be more than is currently circulating in the market, and that would have devastating effects on the price of SpaceX. Um, in reality, that 123 billion is not going to come in and get sold on the first day, and in fact, it physically cannot. Um, there are a bunch of lockup rules for all of the individuals, all of the institutions that got stock before the company IPO'd. And depending on who you are, you get to sell it at different tranches. So the earliest sellers are actually the employees, where um, SpaceX has their first earnings call on, I believe it's August 8th. And then I think a couple days after employees are able to sell a portion of their stocks. And then there's these 70-day, 90-day, 105, 120, 135 days past that June IPO date. I think it was June 11th. They get to sell in 7% tranches. And then you've got, after the Q3 earnings, there's a little bit more that can be sold. And then after 6 months, all insiders except for Elon get to sell essentially the rest of their shares. This is typically what companies do. So SpaceX allowed employees and some of these earlier investors to actually sell before the traditional markets would allow for. Normally, it's everybody has to wait till 180 days, and as soon as that 181st day comes, anybody can sell any amount. So this is a little bit different. And then the last tranche is when Elon's shares actually become eligible for transfer, which is a full year after the IPO date. So real quickly, and I know we're just tiptoeing over, and we'll take questions right after. What are we doing about SpaceX? Nothing. Monitoring things. We really want to see how this plays out with all of these individuals getting to sell before we seriously consider it for the portfolios. It just, this to me says there's going to be a lot of selling in this period of time. Could there be buying following it? Absolutely. Could there be buying in between each of these tranches? Absolutely. It's going to be pretty volatile. Do I think SpaceX has a place in the portfolios eventually? It's entirely possible. I'm very bullish on space in general, but we want to wait and see on this one, because we do feel like during this period of time when all of these people are going to be trying to sell, it's going to push the price down, and there's going to be some high volatility days. So for now, we're monitoring it, and who knows? There could be a point in the future where we feel like it has finally become a good value. But for now, we're holding tight and we're watching things. So that is it. If you have any questions, feel free to put them in the chat, and if if you want to set up a call with either Cory or I to go over your portfolio, or to talk about some of the things and go into greater depth of what we talked about today, feel free to reach out to us. You can go to our website and find our emails are on there, or you can call into our office at any time. So let me stop sharing and pull up our faces. Any questions from anybody?
Thank you all for attending, by the way. We do appreciate it. We love hosting these webinars and showing what we're thinking on a daily basis.
And we try to pick topics that we think, hopefully, that you might have questions about, or we try to anticipate what questions would be asked of us in webinars like this. So hopefully you found it useful. And like I said, if anybody has any follow up and wants to reach out to either Cory or I, we're happy to oblige. All right. I'm going to end it there. Thanks, everybody. Thanks again for joining. We'll probably have another webinar with another topic next month. So join us then. Look out for our newsletter, and Cory, between Cory and I, we always add in little market pieces in our Anchor Bay newsletter, which goes out once a month. So keep an eye out for those. If you're interested in stuff like this, we'll always have a little commentary in there as well.
If you let an investment nerd ramble, definitely will.
All right. Thanks, everyone.